financial institution, that's a pretty good place to start. Actually, the SEC, the Fed, and the FDIC, the comptroller, the Federal Home Loan Bank, those are actually good places to start, get a career, go do a law degree, and then go to law school. Did you receive my email in regards to the securities exam? Yep. You guys get that? Yeah. So this is the securities exam. Okay, it's they split Series 7 into two. You need the registered representative license to be able to really get into the financial services industry. AXA Insurance, they basically sponsored this. So it's like $88, $113 for the total course. You take the course, you pass it, you're in. Okay, it'll suck you into Morgan Stanley, JP Morgan, Schwab, AXA, Northwestern, New York Life, maybe Goldman Sachs, maybe JP Morgan. But this is a great opportunity to get in. And even if you're an accounting major or marketing major or entrepreneur or digital media, this will get you into the financial services and get you into the institutions. And if you study this and pass it, you might even be able to get into the private equity firms and some of the boutique investment banks because they'll know that you know your stuff. So I'll just pass this around. And if you're interested, let me know so that I can help you pass the exam. Okay. For those of you who are super uber students, or students that want to spend a little bit more time and nail down and solidify your knowledge of finance, and nail down and solidify your ranking in the class, and in the, thank you. Oh, actually, I'll take these back. In the class for the grade, this is the extra credit problem set. I didn't make a copy for everybody because not everybody's going to do it. So I'll leave them over here. And if you want to pursue the extra credit problem set, they're right here. And I also posted the solutions online too, so you can work through them and just see how, what the mathematics and the mechanics are. So you're not like trying to figure the stuff out, you're just like memorizing and looking at the solutions. Those are the two laptops that I can't. How'd you do this?
I'm sorry.
How'd you do this?
You had the
Laptop?
yeah.
No, I did not.
Yeah.
You're awesome.
Yeah, of course.
Thank you. I apologize to have you come over.
No, you're fine. If you need anything else, you are.
Yeah, you guys are good.
Thank you so much.
All right, thanks again.
Of course.
All right, so that's that. And what we're going to do is we're going to have the student class lectures today. I already talked to a couple of the teams, and they said it was pretty straightforward. Again, the solutions to the problems are already up there. I put the instructor notes up there too. Got the PowerPoints up there, and then with the Wiley Plus, you have the narrated PowerPoints, and then they'll even walk you through if you want to actually. Team 2's presentation, I think, will be pretty impressive because they put the solutions to the homeworks actually embedded in the PowerPoint presentation, which is probably not a bad way to go. And then you could just walk us through the logic, and they're accounting majors, so it was pretty easy for them to walk through it. And then the other, Chapter 1 and Chapter 2 is pretty straightforward too. Thank you. And then what I'm going to do is I'm going to expand on Chapter 2 and really set a solid, extremely solid foundation in macroeconomics and monetary policy and yield curve dynamics. The yield curve is really the base rate, really the denominator that really drives valuations for stocks, bonds, real estate, and all the other products in the economy and everything. So I really want to go back and give you a solid, fundamental macro foundation so that then you can move forward on a more technical basis and work through the book and work through the problems. I think most professors, when they teach the class, they really just focus on the book and then chronologically go through it and really focusing on the micro pieces, where you really need to have an organic view and a broader view and then drill in to the finance. Okay? So that's really my methodology. And then just to I'm just kind of going through all this stuff. If you want to see the quality of the product, which you're gonna be producing at the end of the semester. Here are some samples. I would actually go ahead and take pictures of these to use as templates. And then I'll walk through one of the presentations. But this is the quality. Do you guys do stuff like this in your classes at this level? You guys produce business quality pitch books and texts and stuff like that? This is what you do in grad school. Basically, just produce a product. And since most of you would already have 3 to 5 years of work experience, this stuff you totally get. But I'm not really sure why they're not training you in this stuff, particularly in your marketing classes, right now to be able to produce this kind of product. Okay? So this is really one of our end objectives, along with others, okay, is to produce this kind of product. So does everybody or each team have at least one of these so that you can share and look at? Let me walk you through one real quick. So this is very specific in its production style and its production specifications. So you really have to adhere to the production guidelines, not only for the quality of the content, but also the quality of the actual physical product. And it's very specific. And some of the students, excuse me, some of the students, you can talk, but you need to whisper, or just go around to the other side and whisper. Very, very specific, and when the students start to deviate from the content guidelines and from the production guidelines, I throw them away, because I can't use it, okay? Because they're very, very specific. And wherever you go to work, there's going to be extremely strict guidelines on the format and the content and the production quality of everything that you produce. And if you want to do stuff your own way, well, if it's more creative and it's a better approach, they'll probably approve it, but you can't do what you want, basically. You got to do it a certain way. So the first thing is you have to have a clear cover on this thing. Okay? So I got to be able to see through it. Not one of those opaque ones, because the very first page of the presentation is the most important thing. It's the first thing that the client or the customer is going to see when they look at this thing. So they're going to judge your work by the very first page. Okay? And this isn't a great first page, actually. I don't really think this is a great first page. This is actually a better page, really clean. This is a little too much color. I'm actually going to swap yours. So very quickly we know what the analysis is. It's on JP Morgan. We know what the recommendation is. It's a hold. We're going to hold this security. Right off the bat, we know what the intrinsic value is compared to the current stock price and if it's trading at a premium or a discount. Very quickly, and then the team. Then the second page, you have an outline. Oh, I forgot to tell you. Clear cover. Okay, hold on. I just get really distracted when people are talking. That's okay. I don't mean to be rude or mean or anything. It's just, I try to get on a train, and it's just because I have so much stuff I'm thinking about. So it's got to be a clear cover, and you got to use this wire, plastic covered wire. It's got to be exactly like this, and you got to have a black cap. And the production material I've already pre-ordered for you in the print shop, so it's really cheap, okay? And then you can send them the PowerPoint presentation to them, and they'll print it out in color, or you can print it in color. So then you have your outline that you're going to go over. This is the deck, this is the pitch book. Then you got the background of the company, maybe a mission statement or some goals, objectives. You get the leadership, you got six of the top executives within the bank that actually run a division, not the board members. Board members don't do anything. It's people who actually run, profitable business lines within the institution. As you can see, actually this is pretty good. We have 3 women in the top leadership role, which I think is pretty good. If it was Goldman Sachs, there'd only be like 1, or maybe none. So really it tells you right off the bat what the culture of the firm is like. And we know what the person's name is. We know their title. We know the number of years they were with the bank. We know where they were prior to that, if they had any prior work experience. And then we know what MBA program or JD program they came from. Usually Goldman Sachs and JP Morgan will hire from the Ivy Leagues. And then Wells Fargo and some of the regional banks here, if you look at the leadership, they all come from Cal and St. Mary's and State and stuff like that. So it's kind of interesting right off the bat to see who it is that they hire. Then basically we have the products and services, and we have the contribution to the total revenue stream for the company. So right off the bat, we know what their comparative advantage is by product distribution and product attributes.
so I was at HPE over the summer, and on theirs, they actually put highest qualification as well. So like if somebody went to, let's say, Harvard grad school, they'd have that.
That's
or
it,
if they,
that's what I'm saying.
okay.
Yeah,
Yeah.
yeah, I'm saying that underneath the, where they worked prior, they would be MBA, Harvard, MBA.
Oh,
MIT,
that
or
is
something like
as
that.
well, or
Yeah.
potentially in place.
Yeah, where they went to, where they did their grad.
Oh, got it. Okay.
You know, unless they went to Wharton undergrad or something, you know what I'm saying? But yeah, you would do that.
Okay.
Okay, and most of those have it. So the products and services, the SWOT analysis, did you guys do SWOT yet? You done SWOT? Strengths, weaknesses, opportunities, threats, that's gonna be in your capstone at the last semester. So you put that in there too. And I'll provide you with a lot of the resources, so you can scramble around and find a lot of this information. Then you have the bank rankings by assets, and this is the peer group, which we're gonna calculate the peer group ratios. You have the financial condition, overall financial position, financial condition. So we got JP Morgan compared to B of A, which is totally as their direct competitor. And then we calculated the weighted average financial ratios as the peer group using the total assets. We have the industry average, and then basically we conduct a financial ratio analysis and we give it a condition, either excellent, good, above average, average, below average, you know, poor. Usually these top 5 banks, particularly in the United States, don't have, you know, average or below average or poor financial ratings because they're in the top 5, you know, the top 5 banks globally and domestically for a reason. They're some of the best run companies, you know, in the world. It's only banks like Deutsche Bank, you know, or maybe Credit Suisse, you know, out of Europe, or maybe some Japanese banks that are basket cases where you can see some of the poor financial ratios. So you do 2 pages of that, and then you give it an overall financial condition or position, which is basically the underlying fundamental analysis that you've conducted to then go forward and conduct the securities analysis, okay? And I highly recommend that you read the book, okay? Because a lot of the conversations and the language that I'm using will be in the book, so as you read the book, a lot of the stuff that I say will make more sense. If something doesn't make sense, please stop me, and I'm more than happy to clarify. Just don't be frustrated, and then take it out at me at the end of the semester, okay? And then we're gonna do a technical analysis where we look at basically the price movement in the stock chart, or the stock, based on the last 3 years, and we conduct technical analysis, and I'll train you how to conduct technical analysis. Okay? And then we have the perpetuity model, which you'll learn, which is a pretty simple model. It's just a cash flow divided by a return, expectation, or a discount rate, and that gives you a value. So the assumption is the cash flow, we're gonna use earnings per share, stays constant forever. So we run that under different sensitivities, the sensitivity analysis. And I will go through how to come up with the sensitivities, okay? And we'll walk through all that, the mechanics. And then the Gordon growth model, it's a very simple model. It's just the cash flow divided by the return minus the growth rate in the cash flow forever. It's gonna give you another valuation. Then you do the PE multiple approach, which you find a PE multiple. I'll teach you how to come up with one, how to use the peer group as a guide. We project out the multiple, we project out the earnings per share, we multiply them together, we get a valuation, okay? Under different scenarios, again, I'll train you on all this stuff. And then discounted cash flow, okay? I got the earnings per share projected out, I got the total value projected out at the end of the 5-year period. I discount that back. I'll teach you discounted cash flow methodologies and what a discount rate is, discount factor, and future value factors, and how you apply all those in the discounted cash flow model. The discounted cash flow model is the heart and soul of the class, okay? It's what everybody's gonna use, because at some point in time, you're gonna be asked if you work as an analyst or you work in any function within any department, doesn't matter what it is in your company, you're probably gonna have to come up with an annual budget and some projections. You're gonna have to go to the board or senior level managers to propose an advertising or a marketing campaign or a new product launch or an acquisition of a company or an acquisition of a stock or an acquisition of anything. You're usually gonna have to do some kind of projected cash flow, and then use the discounted cash flow methodology to come up with the present value. And then we're gonna learn about net present values and internal rates of return, as basically decision-making metrics to then be able to make that investment decision to either go or not go. And then I will basically teach you about the strategy around discounted cash flows, depending on if the manager or the company wants to go through with the project. Then we can go back and change up the scenarios, and I'll train you on all that stuff. And then at the end, you have the 4 methodologies. We have different weighting scenarios. We pick the scenario that we want to use to weight these methodologies, and we come up with a weighted average valuation, and then compare that to the current stock price. And if the valuation that you come up with is higher than the current stock price, what would be your recommendation? If the value that you came up with is higher than the current stock price, what would be your recommendation? You buy it, okay? If your intrinsic valuation is lower than the current stock price, what would be your recommendation? Sell it. And if the intrinsic value is the same, or right around the same as the current stock price, you would hold it. And that'll be our recommendation, and then what we'll do is we'll expand that recommendation to include the derivative trades that you'll be doing in your memos. So that this becomes basically an investment management piece that you would be doing as an analyst, or as a portfolio manager, or maybe working in investment banking, or some other function, strategic function within the firm. And this is kind of where you want to go, in my view, okay, within the firm. You want to be working with senior level executives, you want to be working with the board, you want to be working at some point in time on either new product launches or new company acquisitions, or maybe one of your divisions within the company is so successful that actually the value of that product line or that divisional line is more valuable if you spin it out as a startup in an initial public offering than keeping it internal to the firm. And then you swap that one out and build a new one. So you're swapping them out over time, creating huge wealth for the company. And then you have your final recommendation, and then you have the references in the back, and that's it. That's your pitch book. Okay. And you can people will do 100 of these things, 25 of them. I'll sit through and flip through, approve them, and then we get into an investment committee to basically go through the securities, go through the acquisition, go through whatever it is, and it's either accept, reject, go back, work on it, accept, get going, go do it, go execute. Okay. So everybody has their, we didn't do the pre-test, did we? No, so we haven't gone through that. We didn't go through the, quiz, right? Those are the things we need to go through, right? Along with the chapters and the problems and stuff. Okay. Does everybody have the statistical pre-test? Do they have a copy of the exam? Are y'all loaded up and ready to go? And then we do have to talk about the memo at some point. Did I do an intro to the memo yet? And how to approach the memo? Okay. I have an old version of my book. Anybody interested in it? Let's see if I can do it. We have the book. Exam, we got the syllabus. All right, so we're ready to go. I think what I'm going to do is I'm going to have you guys go first. Okay, and we can blow through that. And then we'll do the statistical pre-test, we'll do some of the exam, and we'll start working through that stuff. It's going to take a long time to get through the exam and the pre-test. I would go ahead and start working on the pre-test. Don't get stuck, on any of the questions. If you get stuck, just move on and just keep going, okay? And then let me see the pre-test. Maybe I can take a look at it next week or something. You can bring it. And then what I'll do is I'll go through it really quickly after you've done it and after I've checked it. But again, it's pretty straightforward except for maybe a half a dozen other questions you won't know because you got to have at least 25 years of experience in doing all of this. So I'll teach you some of the secrets around how to build the models and what you're looking for. You probably have it. I've already gotten it in your quad class or maybe some of your econ courses or something. But I'm trying to teach you the stuff I know so that you can walk out of here with my knowledge, right, and give you a comparative advantage. so are you guys ready? Yeah. All loaded. You know, I've already, are you guys gonna do just the straight?
Yeah.
Chapter 1, and you guys have a modified chapter 2?
Yeah.
We're doing chapter, we were gonna do chapter 2.
Okay, so I'm doing 1.
Yeah.
And then you guys have a modified, and you're gonna load it up. Okay, so I'll do chapter 1 real quick.
Okay.
This one?
And if you want, you can pull up the presentations from the website and follow along. Is probably a good way to go. Oh, but I forgot. What you need to do is everybody turn on your computer and go to Yahoo Finance. Okay. I like to do this exercise right when I do. And I promise that now that I know that there's not a class before this class, I will get here early and basically put the schedule up on the board so you know exactly what the expectations are. Okay. I can't, it's really hard for me to teach these classes when there's a course before it, because I usually like to get here about an hour early to get everything all set up so that we just boom, really productive. Okay. So do you have your Yahoo Finance up? Okay, everybody, okay, so this is what I'm trying to do here. Is trying to simulate a trading room. Okay. So if you go to Deutsche or Wells or B of A or Goldman or JP Morgan, pretty much anywhere, or you walk into a CFO or CEO's or COO's office, they're going to have basically a bank of computers on their desk. And they're going to have their stock price up, they're going to be looking at the market, they might have Bloomberg, they're going to have internal data sets that they're monitoring in real time, they're going to have external data sets that they're monitoring in real time. So now basically it's a war room, you know, these days. So you're working in a room, you're basically the trading room. First thing we do is this is 5 o'clock in the morning, Pacific Standard Time, the New York Stock Exchange is going to open basically at 6 o'clock, so we need to have a morning briefing every single morning to basically get an update on the markets and then get your views, ideally at the end, what your view is and where you think the markets are going to go. Because what you're going to do is I'm going to go, oh, that's great, what would be your trade recommendation? And you're going to tell me based on the economic and financial logic, and I'm going to go, great, go do it. Oh, and then here, Larry, Managing Director, here's basically the trading briefs that me and my team have been working on over the last 2 days. Why don't you take a look at them, and if you approve them, give us the $25 million that we're going to need to place these trades over the next 2 weeks. Okay, this is how it works, man. I'm telling you, this is exactly how it's done. And people are trading on portfolios of at least a couple $1 billion. Okay, the standard exchange traded fund, the mutual fund, is at least a couple $1 billion. And some of these companies in my space are at least 18 billion in market cap. And a lot of the portfolio managers, you know, are running books, you know, of billions of dollars. So they're really smart. They think really fast. They talk fast. They know all the economics. They know all the finance. They know all the accounting. They know all this stuff. Okay, and then they're able to trade it and take the information. So quickly, where's the Dow right now? Where's the Dow? And the market's been open since 6 o'clock, so we're about 4 hours in, 5 hours into the trading day right now. And there's been a lot of news on the NAFTA and news on some other stuff that could be moving the market. But I think the last time I looked, the market was up like, I don't know, 0.5% or 50 points. Where's the Dow right now?
Down 15.
It's down, so it's at like 26 something. Yeah, and then we're almost at the end of the trading day. I mean, for end of the week, and things start to slow down on Friday. So the majority of the trades have already been done for the week, and then people start to go up to the Hamptons and stuff like that, you know, on Friday afternoon. So where are we for the week? Can you go back and tell me what the Dow's done for the week? And then you should get perspective. What has it done over the last week, the last 2 weeks, the last 2 months, and the last 2 years? So you need some kind of historical perspective. Can anybody tell me what may have been driving the markets down? The only thing that would drive markets down is either fear, geopolitical fear, lower earnings expectations and lower earnings expectations growth. Maybe Apple missed its earnings, you know, it was too early for earnings season. Maybe interest rates have started to tick up on the 10-year or maybe the 5-year, the 7-year, maybe you got rising interest rate environment that's going to cause the stock prices to go down, or just people are just freaking out a little bit, but it's not a major move. You may want to write this down. If the stock market drops between 100 to basically 250 points, that's just noise, okay? If it goes up 100 to 250 points, that's just noise, okay? But if the market drops or goes up 500 points, something happened, there was an announcement, okay? If the market drops by 1,000 points, and it never really goes up 1,000 points, but if it drops 1,000 points, something major happened. Either, airstrikes in, Iraq or Iran, or maybe the Saudis have been, attacked, or there's been a bombing, in Riyadh, so it impacts, the global political structure. Maybe Kim Il-jung is sending, missiles over Japan again because he's not getting what he wants in the North Korea, nuclear negotiations. That'll cause the market to be volatile too. So again, 100 points, 200-point movement, no big deal. 500, probably some announcement. Any movements of 1,000 points, particularly on the down, something major's happened. Okay. So, did anybody have any information on why the market went down, or is it just noise? And what you're going to do is you can go to Bloomberg, you can go to New York Times, you can go to Financial Times, you can go to Economist, you can go to Thomson Reuters, you can go to StockCharts.com, you can go to Big Charts, you can go to all these, and they're going to be flashing. And particularly in Yahoo, I'm not a big fan of Yahoo, but Yahoo will show you all of the stuff that's streaming, that particularly political, right up front, and then when you go into the finance page, you can scan it very quickly and see if there's been any news that's now trending and feeding and starting to impact the markets. So is there anything out there?
I'd say it's just noise.
Just noise. Okay, so let's do oil. Where's the barrel of oil trading right now? And again, if you go to Yahoo Finance, you can scroll across and boom, your data's right there. You can click on it and you can click on the graph and you can get the historical charts. So where is it right now?
It's up about half a point.
Oh boy. So we're starting to breach 70 bucks. The oil in right around the financial crisis, in 2008, 2007, around in there, 2000, oil was as high as about 114 bucks a barrel, which was really high, and it basically floated around 30 bucks a barrel for decades, and then it spiked up, and then there was huge volatility, and then it crashed again, and then spiked back up to 90 bucks a barrel, and then last summer it went down to around 40 or 30 bucks, so it lost about 70% of its value about 3 years ago. This was a big disruption to the market. But the oil prices are up significantly now, so either there's supply constraints going on out of OPEC, they're starting to pull back on supply, or there's some reason, maybe geopolitical, that's causing oil prices to go up, and that's going to flow right through the gasoline and petroleum prices and inflation. And if oil prices keep going up and the inflation pressures are there, the Fed will continue to raise interest rates. Okay? And probably the reason that oil prices are up is China's basically growing very rapidly at about 7% GDP, along with India, and we just came out with our GDP numbers yesterday. And what was the GDP numbers yesterday? How fast did we grow? This is a big deal, because the Fed's going to continue to raise interest rates. So just Google, GDP. I think it was like 4.2, and that's well above the 3% that the Fed is targeting. So it's like 102 basis points above its target. So that means that the Fed's probably going to move on raising interest rates because growth is so strong. So what about gold prices? Gold prices per ounce. Gold is a commodity. It usually tracks inflation. I'd be interested after the GDP numbers have come out and the Consumer Price Index numbers came out from the Bureau of Labor Statistics at about 3%. We got GDP at 4.2. We got unemployment at 3.8. Those are all like really strong, healthy numbers, okay? Which theoretically will flow through to inflation and should push gold prices up. But gold has not been responding to inflation, so there's some reason. So where is gold trading right now per ounce?
It's down.
Yeah, so it's not, for some reason, I don't know why gold, maybe the long-term inflation expectations associated with gold, they're seeing deflation or potential recession in the future. or maybe the gold prices have decoupled from the underlying fundamentals. I don't know, maybe you'll figure it out. So where is the 10-year treasury yield right now? It's the benchmark interest rate in which everything is priced off of. Student loans, car loans, mortgages, borrowing costs for corporations. So where's the 10-year yield on the 10-year treasury yield? The treasuries are basically US government-backed securities issued by the Treasury Department at different maturities. So for each maturity, the interest rate on those bonds will fluctuate. Okay, so there's a price for each maturity for the government bonds. And the 10-year is the indexed. It's what everybody benchmarks everything off of. It's the #1 interest rate to follow. So where is the 10-year treasury yielding today?
Down.
It's down? Okay, I think the other day, it was at 2.88, and where is it now?
2.86.
It's 2.87, so it's dropped a little bit, okay? There's really only two reasons why the bonds would fall. One is that lower inflation expectations, and I'll go through the Fisher equation later and show you what drives nominal interest rates. So one could be lower inflation expectations, the other is high demand for bonds, okay? Because maybe there's something going on out there, and the stock market sold off, which means people don't have an appetite for risk, so they're selling off their stocks, and they're buying bonds, driving up bond prices and driving down bond interest rates. So bond interest rates and prices move in inverse relationship. You need to memorize that and burn that into your brain, okay? Because if you ever talk to anybody and you say that rising bond prices are gonna cause interest rates to go up, you're gonna be fired and you'll totally discredit yourself. It's an inverse relationship. So when bond prices go up, interest rates go down. When bond prices go down, interest rates go up. So if the yield went down, then bond prices went up, so there's more demand for bonds. And people are obviously scared in the stock market. They sold off the stocks and they bought bonds. So maybe they sold off the bonds because this week the stock market has been on such a tear, they decided to take some profits. And since interest rates on bonds are so attractive now, I just move my money over into the bonds and lock in a 2.88 rate of return for the next 10 years. It's not a bad deal. Okay, so where is the, now where's the pound to the, or the dollar to the pound and dollar to the euro?
Both down.
So they're both, it's down.
Yeah.
So it's gonna cost me less to buy a pound than a euro. Cost me less. So the dollar per pound, dollar per euro is less. So it costs me less, right? Right? The dollar per pound, dollar per euro, when the dollar to the euro, dollar to the pound goes down, it's gonna cost me less, right?
Yep.
I still get a euro, I still get a pound, but I get to get it for less. So what's happened to the dollar? Did it appreciate or depreciate?
Appreciate.
What?
Appreciate.
It appreciated, right? So if the dollar appreciated, then it's gonna cost me less to buy the euro and the pound. What did the euro and the pound do against the dollar? Did it appreciate or depreciate? It depreciated. So if it's gonna cost me less, the dollar appreciated and the foreign currencies depreciated. And what drives dollar appreciation is gonna be higher expected returns in the US, more stability, lower inflation, differentials, higher interest rates, higher expected returns, higher productivity, lower political risk. That's gonna drive capital flows into the United States and then prop up the dollar and cause it to appreciate, okay? So we'll do that every class. We'll get market update, come in, load up your computers, start looking at the markets, let me know where we are, you know, with the stocks, with the oil, with the gold, with the bonds, with the foreign currency, and if at some point in time, if you can give me some rationale, economic rationale behind what is driving those prices and those yields up and down, you got it. You're in. These are the conversations you're going to have at the table. Because it's the first thing we talk about, okay, is the macro political and the macro monetary environment. And we start drilling into the micro side of the equation. Okay? So I'm sorry, I didn't mean to cut you up. So I guess I get chapter 1, right?
Yeah.
Okay. Chapter 1's pretty straightforward. I'm not gonna spend a lot of time on it. Really the major takeaway from the chapter is really when you start a company, you have to decide on the corporate structure. You have to decide what kind of corporation you're gonna set up. Do you set up a sole proprietorship? I do not recommend it. It's pretty easy to set up. You just get 1099 income. You just pass it through to your income and you pay the income tax. Okay. Problem with the sole proprietorship, even though it's simple, is you're totally liable. So if you do something stupid and you get sued, the person's going to sue you and they're going to attach to your current wages and they're going to try to steal all of your assets. Okay. So most individuals who are pretty smart don't do a sole proprietorship. They'll do an S corp. Okay. Or actually, what they'll do is they'll do an LLC, a limited liability corporation. A limited liability corporation is pretty simple to set up. What I would do is either you can hire an attorney and they'll do it for $3,000. And again, I'm not making this recommendation because I'm not an attorney, but I am an investment advisor, so I can at least guide you in this. If anybody does get into the business of investment advisory, you have to qualify yourself constantly when you're having conversations, so you're not misrepresenting yourself. So I can give tax advice and I can give legal advice, but I can't. But I'm not an attorney and I'm not an accountant. So you have to go to your attorney and go to your accountant to make the final decision. But I can guide you. But I'm not making the recommendation because if I do, I'm liable and I'm misrepresenting myself as an accountant and an attorney. Okay, even though I'm an investment advisor. So you want to go to LegalZoom.com. I've set up C Corps, LLCs, S Corps through LegalZoom.com. It cost me like $300 to $600 depending on the type of corporation I want to set up. It's really simple. You can do it. So if you want to form a partnership with somebody who will be sharing the risk and the revenues between them because you're starting a new startup company or you're inventing a new software application and you're going to split the revenues under your contract, you probably want to do an LLC. It's pretty simple. It's a pass-through entity. The money comes in and it passes through to you as a 1099 income, and then you report it as your income and you pay the income tax. But the LLC basically creates a veil that nobody can penetrate if they want to sue you. So if you screw up and you get sued, they can sue the entity, but you've already passed through all the cash flow to the to you and your partner. So there's really nothing in the company, maybe a little retained earnings and maybe some computers as assets or something. So the LLC is really the easiest, the cheapest, and most people will form an LLC. The next is the S Corporation. The S Corporation is like a partnership, but it also has characteristics like a corporation. Corporations are considered individuals under the recently Supreme Court ruling over the last 10 years under Scalia. Basically states that the corporation is an individual, it's a perpetual entity, it protects against being sued, and the S Corp has securities that are not publicly traded but are distributed to the shareholders, and you basically share in the revenue based on the amount of shares that you own in ownership interest. It has some tax loss and some loss expense characteristics to it that are advantageous that some people do in S Corp. Personally, I'm not a big fan of the S Corp, although some people like the S Corp. I like the C Corporation as a better entity. Unfortunately, the C Corporation costs more money because you got to hire a CPA to basically do your audited financial statements, which isn't a bad thing, because if you do get a CPA to do your taxes and get somebody to do your bookkeeping signed off by the accountant, the probability of you actually getting audited by the IRS drops significantly. So the C Corp also creates a protective veil, but I like the C Corp, even though it costs me about $1,000, maybe $2,000 a year to keep the C Corporation because of all the accounting fees and stuff that I have to pay. But I really like it because one, I'm running a C Corporation. Okay, just like any other major corporation as the president of the company. I'm also the secretary of the treasury. I have a board of directors. We do annual board of director meetings that lay out the rules, basically, of governance for the corporation. I can deduct all the medical expenses through my C corporation, which is extremely advantageous. I can pay myself a salary, I can pay myself a bonus, I can actually pay myself a bonus, pay the taxes, then take the money and fund life insurance policies that way. I can also deduct the long-term care insurance for me and my wife through the corporation as a medical expense, which is extremely advantageous too, because that's really expensive. And then I can set up a defined contribution or defined benefit program to basically fund as my retirement account, so that when I reach 65, 75 years old, I got 2 or 3 million in there that will kick off an annuity cash flow for the rest of my life. It has a veil around it so that if I get sued, nobody can pierce it, and I can actually fund the corporation, put money into it, and to fund the equity shares and receive shares in the company. I can also loan the company some money and get paid back that way too. And then if my company does get really big, I can basically issue stock grants or stock options to my employees and align their interests with the overall objectives of the firm. And there's obviously other, and the other is at some point in time, if I do get big enough and some company wants to buy me, I can basically swap the shares for cash or swap their shares for my shares in an exchange transaction. So it's very flexible. It's more expensive to run, but I really like it because the benefits outweigh the costs associated with it. And that's really the chapter. I'm not going to go through the slides, but that's really the chapter. Does anybody have any questions about how to form a corporation? The advantages, disadvantages because you're going to form corporations. You're going to form companies. You're going to form LLCs. You're going to probably do maybe an S or a C corp. And if you're going to be a CPA, or an attorney, you're going to set up a limited liability partnership, an LLP company, and become an LLP, and maybe an S corp too. So you're going to be dealing with this stuff. So then you're going to have to make a decision at some point in time based on this. How are we going to structure the entity? What's the structure we're going to use? And I like to use the S corporation because I can get bought out. If all of a sudden my company makes a bunch of money and I got IP, I got assets, I got cash flows coming in, I have an exit strategy and I can sell the company at some point and have an exit strategy. Can't do it really with an S. And to go from an LLC and an S to a C is a pain in the ass. Okay, so might as well just set up the right corporate structure right off the bat if you can afford it. Okay, any questions? No? Okay, yes sir.
Just that, how difficult is it for a company that's already established as maybe, let's say, dual partnership to become an LLC? Because I know the company that I was working for 2 summers ago, they actually, since I was working there, became an LLC.
Yeah, you're gonna have to go back, you're gonna have to work with attorneys to basically go back and restructure. You can go through all the legal alignments and restructuring that's necessary to refile. Okay.
And why do you think they would have wanted to do that?
To do an LLC?
Yeah.
As opposed to a partnership?
Mm-hmm.
The partners probably had more liability.
Okay.
In the LLC, basically the entity becomes the liable entity as opposed to the partnerships. So if one partner does something stupid, then the other partner may be involved, okay? Where the LLC is the entity. And basically, if the entity gets sued, you can always start another one and then collapse that one and let them sue that LLC. So it's probably from a liability standpoint, why they did it. Okay, any other questions? Okay, cool. So let's do chapter 2. And what was chapter 2? Oh, this is my favorite chapter, even though we don't really talk much about this. And this chapter is really just a foundation for the quiz. Okay, so I'm going to really expand on this chapter.
Chapter 1's not on the
No, it's really, there's only nothing there. Chapter 2, there's something there. Chapter 3, there's something there, but the quiz is more for my and that kind of makes things happen. when you guys are ready, thank you.
So we had chapter
And then
two.
I do have one question. You can do it either way you want. I've had a couple students that say no. What I do is I basically record the lectures, and then I post them on YouTube. Do you want me to keep them available to the public, or do you want them private? Or do you care? Do you not care?
Don't care.
Because I had one student that was from the East Coast, rich family, and just didn't want to be profiled. Okay, cool, awesome. And then are you guys getting all the videos and stuff? Did you get the videos that I sent you?
Yeah.
Okay, cool. Thank you very much, I appreciate it. Sorry to interrupt you.
No worries. Chapter two, it's about the financial system and the level of interest rates.
Jerome Powell is now the Fed chair.
So basically, some of the learning objectives of this chapter were to just basically describe the role of financial system in the economy, talk about direct financing, what roles investment banks play in the process, also explain like the different types of money markets, what an efficient market is, how financial institutions serve consumers, and then talks about nominal real rates of interest. So the financial system right here talks about markets for trading financial assets, such as stocks and bonds rather than real assets, like cash, real estate, yeah. Some financial institutions include banks, credit unions, insurance companies, like Bank of America, credit union. Like credit unions are usually smaller. Insurance companies. Financial system is competitive. Money is borrowed throughout amongst companies.
And I do give extra credit for notes. Go ahead.
Yeah. So basically, funds flow through the financial system. There's a chart on the next slide describing it, does a better job showing how money flows from lenders through the markets to borrowers like ourselves, borrowing money from banks for mortgages or student loans. Coming from the lenders are households, business firms, and governments. Well, the government, excuse me. And that's through direct financing and indirect financing.
And this is called financial intermediation. Okay, the capital markets, financial markets are an intermediary between the lenders of capital and the borrowers of capital. And the financial institutions are the intermediaries also between the lenders of the capital and the borrowers of the capital. So corporations basically borrow, and governments borrow money from savers like yourself. You're basically, when you buy a bond or you buy a stock, you're basically lending the corporation or lending the government money in return for a return or some type of interest rate. So this system of financial intermediation is basically the heart of capitalism. Okay, this is capitalism at its best. Okay? And we have one of the deepest, most efficient, and most powerful capital markets and financial institutions in the world.
This slide talks about direct financing, how the minimum transactions are $1 million, so these are obviously larger loans or transfer funds. Investment banks and money center banks deal with these types of transactions.
Let me talk about what the difference between investment banks and money center banks are. So money center banks are like Bank of America, Citigroup, Goldman Sachs, Barclays. They're large money center banks located strategically across the globe. Okay? And they're money center banks because they deal in foreign currency transactions, and they use derivatives, they provide trade financing, and they basically do everything underneath the financial services of the world. So these are the money center banks are the biggest banks out there, and you recognize them. The money center banks usually have a division called an investment banking division. And the investment banking division basically works with governments and corporations that need to borrow money from the markets, and they basically underwrite the securities to bring those securities to the marketplace and then exchange the money for the securities. So the investment banks not only do mergers and acquisition consulting, but they also are instrumental in bringing new securities, both debt securities and equity securities to the marketplace. Goldman Sachs, JP Morgan, BofA, Citigroup, all of them are have very strong investment banking divisions.
So I'm going to talk about the different types of financial markets, the primary and secondary markets, exchanges and over-the-counter markets, and then money and capital markets. So for the primary and secondary, the primary market is a wholesale market where firms whose securities are issued and sold for the first time. And the secondary market is retail market where previously issued securities are resold or traded.
So again, when a company comes to us and say we want to issue some stock for the first time, they want to do an initial public offering, that's the primary market. And once those securities are issued and start to trade, let's say on the New York Stock Exchange or the NASDAQ exchange, that becomes the secondary market. And those securities are priced constantly, continuously, particularly the stocks. The bonds less so, but the stocks, if they're publicly traded, you can get a minute-by-minute, second-by-second update on the price of that security.
And then the difference between marketability and liquidity. Marketability is the ease at which a seller or buyer for an asset can be found. And liquidity is the ease at which an asset can be converted into cash without loss of value. Markets increase both of them of securities, and then financial markets also lower the cost of making transactions and make participants more willing and able to pay higher prices.
So you may want to, if you have some extra money laying around, you may want to go ahead and open up a stock brokerage account, either at Scottrade or E-Trade or Schwab or Fidelity. Start investing in some stocks, open a brokerage account, and then you'll have access to all of their research. You just play around, learn how to trade some securities, or just buy one. There's probably a minimum account size, but I would start doing that.
Do they give you recommendations like through?
Usually the full service brokerages like JP Morgan and Merrill and Wells, depending on what kind of client you are, you can have access to their research, but there's so much research out there. You can get Fidelity and all those guys provide research now too. But they may not do recommendations, but they'll provide you with the research for you to make your own recommendations.
So brokers and dealers, the difference of the two is a broker brings a seller and the buyer together. They're kind of like the matchmaker of sorts. And the dealer participates in the trades as a buyer and or a seller using their own inventory. The broker doesn't take on any risk. The only thing, they get a commission based on whatever is traded, but the dealer does take on the risk because they're the ones buying it or selling.
Yeah, so the dealers, they're an interesting role in the capital markets. The dealer actually has a book, let's say Apple stock, okay? And when Apple stock starts to rise too fast, they will start to sell their inventory to try to tap down the stock price, to create an orderly market. If all of a sudden Apple stock drops significantly, they'll start to buy the stock. So basically they're making a market in the stock to keep the stock from going up too fast too far or going down too fast too far. So they actually have a book, of the securities that they're making a market in. Go ahead.
Okay, so the next one is exchanges and over-the-counter markets. So an exchange is a location where sellers and buyers meet to conduct transactions. And one of the most famous ones is the New York Stock Exchange, which most people know, and the Chicago Board Options Exchange. And an over-the-counter market is the dealers conduct transactions over the phone or through computer. So that's like the NASDAQ.
Yeah, and I highly recommend you go visit these websites. Okay. There's a lot of information there.
And then there's the money and capital markets. A money market is a market for low-risk securities with maturities of less than a year in a capital is for the maturities for greater than a year. And the money markets have treasury bills and commercial papers, and then capital market has bonds and common stock. And a public and private market, is organized financial markets where the general public buys and sells securities through stockbrokers, and a private market has direct transactions between two parties. An advantage would be of the private market is that it's faster and a lower transaction cost. And a disadvantage is that privately placed securities can't be sold in public markets because they lack SEC registration. And yeah, dollar amounts that can be raised tend to be smaller. And this shows the size of the U.S. markets for each money market and capital market instruments.
And these are in trillions. So you can see that the Treasury notes is around $11 trillion. Corporate bonds is around 10 trillion, and then the stock market is around 31 trillion. So this is just a snapshot of the capital markets. So the size of the capital markets, both the debt market and the stock market, is around 70 trillion. And you could probably multiply that by 3 to get an idea of the total global size of the security markets. So it's huge. And again, you get your little self in front of all of those capital flows, and you'll probably make a lot of money. The idea is just to get in front of it, get in front of the flows, and own some of it.
So next up is futures and options market. This talks about derivative securities that derive their value from some underlying asset, like future contracts. They're contracts for the future delivery of assets such as securities, currencies, cash flows, or commodities. And then option contracts call for the option writer to buy or sell.
And we'll be doing a lot of futures and options. Theoretically, we'll be trading based off your recommendations, and then I'll do an introduction to futures and option contracts really soon.
Next up is market efficiency. This is basically talking about how an efficient market is one where the current prices incorporate the knowledge and expectation of all participants. The prices are correct, not overvalued or undervalued. Operational efficiency is the extent to which transaction costs are minimized, and informational efficiency is the extent to which security prices reflect all relevant information.
So the dichotomy here, there's a battle between the two worlds. Okay, there are people who believe that the markets are efficient and that the prices of all securities reflect all the information and forward-looking information, all embedded in the current stock price. Then there are other people who think that markets are inefficient and that there's a lot of information that's not being reflected in the current stock price, and that by looking and conducting technical securities analysis or conducting securities analysis, that you could actually determine the true value of that security. And if you can see that the security is mispriced, you can trade on it and profit from it. So the efficient market says all the information is already embedded in the price, you can't profit from the research. Then there's the technical people that say, and the inefficient market hypotheses people that basically say, no, a lot of information is not reflected in the current stock price, and if we conduct the fundamental securities analysis and technical analysis, we can identify trends and we can identify valuations that may not be reflected in the current price, and we can trade on it and we can profit and create arbitrage. I'm the latter. I believe that the markets are inefficient to a certain degree.
Next up is the 3 different forms of an efficient market. The strong form is the security or the stock prices. They reflect all information, public or private, to come to one price.
And this includes insider information. So all information, even insider information, is already reflected in the current stock price.
The next one is semi-strong form, which only includes all public information. it doesn't include any insider information or private information.
So it includes the historical price charts, plus all of the financials that are recorded on a quarterly and annual basis, audited financials. All of that information is also embedded in the current stock price, in which totally, the weak form, we're gonna violate the semi-strong form, because we're gonna conduct the intrinsic valuation analysis at the end of the semester, and I'm gonna show you that running that analysis, you're gonna be extremely accurate in your prediction of the stock price, because I would say at least 90% of my students who go through this exercise and make that recommendation are correct.
And lastly is weak form, which only reflects historical information. So basically trends over the past, like past information.
And actually, I don't believe in that either. The weak form is basically shows, I can look at a price chart for a stock going back 3 to 5 years. I can identify trends, I can identify supports, resistance lines. I can look at the technical analysis, and from the technical analysis, I can project where I think the stock price is gonna go. You can also make money on insider information. So basically, the efficient market hypothesis is a hypothesis, and in my view, is violated, and can be violated, and can be utilized, if you understand how to take advantage of the market.
So public markets, like the New York Stock Exchange, are a lot more efficient than private markets because of the information, the amount of information that's like flooded with the public information.
So indirect financing, banks and insurance companies, they both borrow and save. They borrow money from the saver. They lend the money to a borrower, and they must repay the funds to the saver, whether or not it's repaid by the borrower. The process of converting financial securities with one set of characteristics into securities with another set of characteristics is called financial intermediation. So financial institutions, they provide lending and borrowing opportunities at the retail level for both small customers and wholesale level for large customers. They efficiently collect funds in small amounts and lend them out in larger amounts. And then they tailor loan amounts and contract terms to fit the needs of the consumers, corporations, and small businesses. And then there are a few different types of financial institutions, commercial banks, life and casualty insurance companies, pension funds, investment funds, and then business finance companies.
And why don't you leave it on that for a second? Investment funds are huge now. You've heard of hedge funds? You heard of hedge funds? Yeah, those guys live, they're all quant shops, they'll trade anything, they're really smart, it's a $1 trillion industry. And now the private equity funds are really big too. Venture capital funds are also investment funds. And now there's the impact investing funds that are coming out too that are extremely popular. Pension funds are if you work at the state of California or any state, the fire, the police, the teachers all pay into a defined benefit program that basically guarantees them an annuity for the rest of their life. So pension funds and pension fund advisors and consultants, that's a big multi-trillion-dollar industry. We already know about commercial banks, and then life and casualty insurance companies, the life insurance companies, particularly the mutual insurance companies like New York Life, Northwestern, Ohio. These are really big financial institutions that are very conservative in where they invest. And they basically build a product called life insurance, where basically you give them a premium every month, every year for 20, 30 years, maybe for 50 years, and they'll guarantee that you can borrow back the money that you put in tax-free. You can pull it out, they'll guarantee a rate of return. And then the death benefit, if you do pass away, if it's term insurance, it'll term out. If it's permanent insurance, you are guaranteed $1 million when you die. Guaranteed. Okay, it's more expensive, but it's a pretty damn good product. It was invented 157 years ago, and it's probably the most brilliant, smartest financial product ever invented. And it's been around, life insurance has been around for at least a couple hundred years. Brilliant. Right.
This next chart shows cash flows between the firm and the financial system. If
you get stuck, you can just keep going.
All right. So the determinants of interest rate levels, the real rate of interest, loan contracts and inflation, the Fisher equation and inflation, and then cyclical and long-term trends in interest rates. So the interest rate is the fee for borrowing money as a percentage of a loan. The nominal rate of interest is the interest rate we observe in the marketplace, and the real rate of interest, it would exist in the absence of inflation or deflation. It's determined by the expected return on investment and time preference for consumption.
So this is the equilibrium rate of interest, and it's a function of supply and demand. So savers supply more funds at higher rates and borrowers demand less at higher rates. Equilibrium is the rate at which quantities of funds supplied equals the quantity of funds demanded. And an economic factor that causes a shift in lending abroad will cause a change in the equilibrium rate of interest. So this is like an example, a graph of it. Yeah, you can see like the equilibrium there.
So if the supply curve shifts out, interest rates go down. If the supply curve shifts back, interest rates go up. If the demand curve shifts up, interest rates go up. And if the demand curve shifts down, interest rates go down. So the interest rate is really the price.
Okay, and inflation in loan contracts, lenders want the interest rates in loan contracts to include compensation for the inflation predicted to occur over the life of the contract. Compensation for expected inflation adjusts loan rates to offset the higher prices for goods and services expected to exist when a loan is repaid and the lender expends the money. So this is the Fisher equation. So I is for nominal rate of interest, R is the real rate of interest, and delta P sub E is expected an annualized price level change, and R delta P sub E is adjustment of the interest rate for the expected price level change.
So basically the nominal interest rate is really just the real rate plus inflation expectations. That's what you need to understand, is it's not the real rate plus inflation, it's the real rate plus inflation expectations. And you'll hear it when you listen to Bloomberg or you listen to the financial news. The terminology and the language that they use is extremely precise, just like any other language. So it's inflation expectations. Okay, go ahead.
Okay, and the Fisher equation example, yeah, that just shows.
So basically the 0.04 is 4%, 0.1 is 10%, and so 4% real rate plus a 10% inflation expectation gives you a nominal interest rate of 14%.
Okay. The cyclical and long-term interest rates. This is like a question in the homework, but an interest rate tends to rise and fall with changes in the rate of inflation, and the rates tend to rise when the growth rate of the economy increases and falls when the growth rate of the economy slows. So the interest rates follow the business cycle, and yeah, it rises during the expansion and during contraction. So this is an example of what that looks like.
So you can see that inflation and the yield on the 10-year Treasury security is positively correlated to each other. And the number one factor that drives them to be correlated is the inflation expectation component. Because as the economy overheats, inflation expectations go up and interest rates go up. If the economy is cooling or goes into a recession, inflation expectations go down and interest rates go down with them.
That's it.
Great, thank you. Did you have any homework? Yeah, did you want to, how many do you have?
All for chapter 2.
Okay, you want to just walk us through those?
Okay.
Did you want to put on the projector, or did you have them in your slides, or?
We just,
Oh, you have one, you have one that's.
Yeah,
Okay.
so I'm not trying to.
Okay, did you want to go to this one right here?
What?
Did you want to use this one right here? This right here? Do you-
Oh, yeah, I thought you wanted to.
Or this one?
We just have them written down.
I just
Oh, you do?
wanted to-
Okay.
the-
Okay. Why don't we do those?
Okay, thank you.
So who's got chapter 3? Any questions on that? That was pretty straightforward.
Yeah.
Do we have time?
Are you doing, what time is
Because
it?
we still not go through the homework, right?
They're gonna do that later. What time, how much time?
So we got like 20 minutes.
You got 20 minutes. Can you do it in 10 minutes?
Are we going through homework or?
Or it's like combined with our homework.
Yeah, that's cool.
Simultaneous.
Yeah, that's great. You want to pull it up here? Yeah, next time, let's just throw them in the PowerPoint.
Yeah.
It'll make it easier.
We can include, yeah.
And then you can even just go copy it. From your editor.
Okay.
It's you right there. So it goes out.
Yeah. They were answered in the slides.
Yeah, exactly. You probably don't even need it. Or actually, you should do it. Since you want to do it, show them next to us.
Yeah, we can do that.
So what you can do too, which would be a good way to do it, is when you do the PowerPoint presentation, you go up to the solutions
Is it the
manual
laptop?
and bring in the solutions to the homework and just walk us through that
Professor?
one too. But you're going to need to write it off. Makes sense. Did you get the 100? You need to push the button.
Is it the laptop?
No, it says PC.
That's probably what they did.
Right here. Right here.
Oh, you're right. Short selling the stock. It makes sense because people stock price is going to go down. Well, short selling is risky if you get caught. All of a sudden the stock goes up and you're on a short position, you're probably going to have to buy the stock to offset the position. Because if it goes through the roof, you're going to slaughter. So that's how you unwind your position. You say, okay, stock price is going to go down.
I don't know for sure.
Starts going down, making all this
Probably.
money, great. Then all of a sudden it starts to reverse. And then all of a sudden it goes up even higher than the other side to offset the change. So you can't slow down. It's all, we'll learn about that later on in auction contracts. But that's the way to do it. You just don't take a negative position. You just take the post. You gotta keep going.
Yeah, I have one class where the teacher was saying we need to be like,
Are you? Is it up?
no, I know. It's so hard sitting through an hour. I don't have class anyway. I just have two. It's bad enough.
All right, everybody. We have one more presentation.
The last class is just like
Up innovation.
Okay, and action. Go ahead.
We are going to talk about chapter 3, chapter 2 focusing on financial statements, cash flows, taxes. So basically this is the GAAP, generally accepted accounting principles, and in the US standard at least, all of the financial statements follow the rules of GAAP. Or their guidelines, not rules. And these are the important principles. Assumption of arm's length transaction. Parties involved in an economic transaction arrive at a decision independently and rationally. Second is cost principle. Asset values are recorded at the cost for which they were acquired. And realization principle, revenue is recognized when a transaction is completed, although cash may be received earlier or later. And the matching principle, that revenue is matched with the expense incurred to generate the expense. And last one, going concern assumption. Assumption that a company will continue to operation for the predictable future. And then this is just what the balance sheet looks like. And the equation for the balance sheet is the total assets equals to liabilities plus the stockholders' equity.
And remember, balance sheet is showing the financial position of the companies at the particular point in time instead of like a period. So this is one of the, so this is the key concept of working capital. So the definition of working capital is a measure to test company's ability to cover its short-term obligations. So, which means that assets should be greater than liabilities, which is the formula. Total current assets is minus total current liabilities equals to net working capital. And then this is the homework problem, 3.5, and do you want me to read out?
Yeah, just take us through the, just, what the, what makes up current assets and current liabilities.
So,
And then what the final equation is for the net working capital.
okay, so current assets are like cash, current is like the items that involve within 12 months, which is within a year, which is like cash, inventory, accounts receivables, prepaid expense. So in this question, you can see what related to current assets are cash and marketable securities, and then there's inventories, there is accounts receivables, and also other current assets. So I put them under current assets, that category. And then for current liabilities, there are like accounts payable, short-term loan, that kind of thing. So you can see in the questions there's accounts payable, the item, and also short-term notes payable. And then I
You
put
keep
them.
leaning up against the button. That's okay.
So I put them under current liabilities, and then when you total them up, it's going to form this formula, and that's the answer. And then the next question is something related to income statement. So the purpose of income statement is to reflect the profitability, which is revenue and expense, of the firm over some period of time, usually a month, a quarter, or even a year. And then the formula is revenue minus expense. And then you can see revenue greater than expense going to be net income. And if revenue is less than total expense, is going to be a net loss. So net income is often reported on a per share basis. It's also called earnings per share. And there's like a formula for EPS is net income divided by the number of common shares outstanding. And then this is like a overall like how income statement is. This is multiple step income statement. It's more like detailed. And then this is the homework question. And basically you need to plug in those items and form this table. And then this is the answer of the homework.
Earnings per share sometimes turns out to be negative. And when you have that situation, you have to use EBIT, earnings before interest and taxes, or earnings before interest, taxes, depreciation, and amortization, which would be considered your free cash flow. So it depends on if you're an established firm, you're going to use earnings per share. If you're a startup company in the early stages, you're going to use probably EBITDA or EBIT.
And this is the statement of retained earnings. And the statement of retained earnings purpose is to show the cumulative effect of adjustment to shareholders' equity resulting from profits or loss and paying cash dividends. And this is how the statement of retained earnings should look like. And there is no homework problem really show how retained earnings should calculate.
So I'm going to talk about the statement of cash flows. The net cash flow is equal to cash inflows minus cash outflows. And so this is how the statement of cash flows is organized. It comprises of the operating activities, investing activities, and the financing activities. And what's in the operating activities is usually cash inflows from selling goods and services, or buying inventory, raw materials, and then the investing activities comprises of buying, selling stocks and bonds, and financing activities is usually paying interest, paying out dividends. And this is what the statement of cash flow should look like. As you can see, it's divided into 3 sections. And so the cash flow from operating activities, this is the equation. I'm just going to gloss over all of the equations. So it's earnings before interest and tax minus current taxes plus non-cash expenses. And this is available to investors from the operating activities. Cash flow invested in working capital. It reflects net cash flows into or out of working capital. And the equation is the net working capital from the current period minus net working capital from the previous period. And then cash flow invested in long-term assets reflects changes in value of long-term assets, so usually plant and equipment. And the equation is long-term assets from the current period minus the long-term assets from the previous. And then this is the last equation, cash flow to investors, which is cash flow from operating activities minus cash flow from net working capital minus cash flow from long-term assets. And then this is a homework problem.
In the cash flow from net working capital, if you don't have enough of that, you need to have a line of credit, probably with multiple banks, to be able to cover your cash shortfall over periods of time, if you get into that position.
Okay, so this is the 3.9 question and problems. So basically it's asking the net cash used in investing activities. And so you first need to evaluate whether these transactions are investing activities. And I highlighted the keywords in red, which indicate that they are investing activities. So investment in marketable securities, so you would subtract because that's a cash outflow. Funded fixed assets acquisitions is also negative because it's a cash outflow. Marketable securities, that's an inflow, so you're adding, so the ending balance for investing activities would be that amount. And then the next question is asking about the financing activities. And so again, you're making sure that these items are a part of the financing activities, or else you're not supposed to include it. Repayment of existing debt, so cash is going out, so it's negative. Raised debt capital, you're adding, and then repurchase stock is subtracting because you're paying money to buy the stocks. And so that's the net amount. And then,
So cash flow invested in network capital equals total current assets minus the total current liabilities. So you calculate the current period network capital and the network capital of the previous
It's
period.
networking.
Networking. And the step 2, you do networking capital of the current period minus networking capital of the previous period, and that equals cash flow invested in networking capital. So here it's just showing that exact same thing for the homework problem. So you take the total current assets minus the current liabilities for each year. You'd add them together and then you'd subtract them from each other, and then you would subtract 2017 or 2016 from 2017, and that would then give you the cash flow invested in the networking capital. So if a firm is a net investor, That means buys more than it sells in long-term assets during a given year. Its cash flow to investors will be reduced by the amount of the net purchases. If the firm is a net seller of long-term assets, its cash flow to investors will increase by the value of net sales. And that's it.
That's the end of the presentation?
Yeah.
Oh, congratulations, that was awesome. So, thank you. So I guess we only have like 4 minutes. Let's who's got chapter 4 and 5?
I think we have 4.
4, and you guys have 5. So you want to do that on Thursday, and then I'll do the lecture on Thursday, on Tuesday.
We're gonna do it on Tuesday or Thursday?
You want to do one on Thursday? Do both of them on Thursday, and then I get the whole
That works.
hour.
Wait, we're doing 4, they're doing 5?
Yeah.
And we're gonna,
So we're both on Thursday then?
Yeah.
Okay,
Yeah,
sounds
one
good.
will do Thursday, that'll give you time. I think they did a good job of that. And then,
got us a long time there.
yeah, that was really good. And then I'll do the, start working on the.
Practice reading some books. No, let's do it. No, you can be a voice actor.
I actually do voiceover.
Really? Yeah, exactly.
Yeah, like it's as simple as that. I think we should just bring up MC and that will make it really nice. Yeah, I have Sunday off. Probably do like 10 minutes.
Sunday? I work Sunday. But I mean, like, we can just talk, like, Tuesday we can talk.
Yeah, that's true. Maybe like before or after class, just get into it.
Yeah, split up what we're gonna do.
Yeah.
And then we can share the Google Doc. Same here. Google Drive.
Yeah.
Yes. A plus Sands.
It's all around.
I'll show you right now. So, like this.
Yeah.
Laugh that suck.
I have an email that.
Yeah, that's what it does when it's super flash drive. Like whenever it's my flash drive. It's like always. That's good.
I'll take that.
I think I've always been I thought it was him for sure. 510 is Oakland.
Yeah,
He's from Oakland.
yeah.
Really from
Yeah,
Oakland
make sure all the solutions with my students. Actually, make it easier for you to study. Then do it. So you're not.
No.
See you later. We got the bookstore after the 3rd class.
Like keep this meeting.
Yes.
I'll put that out.
That's what it is. That was awesome.
Thank you.
That was great. I love the way you incorporated it into the presentation. You know, you're gonna be a great presenter. You know that?
Thank you.
You know that?
No.
Yeah, you're gonna be a great presenter.
Improvise.
Yeah, you did good. You're gonna get even better.
Thank you.
Thank you.
Alright, I'll text you, man.
For sure.
Have a video.
Yeah, so then that group, we're not gonna need it.
Yeah, it's okay.
Yeah, no, I don't think so.
That's my best.
I think we're good.
Are you done today? Or you have more thoughts?
No, I got 2 more.
Alright, man.
See you.
You guys have fun.
Bye, Professor. Thank you.
All right, take care. Y'all go work.
Here's the,
Did you want to keep it?
oh, I can answer now?
Yeah, just have it.
Oh, great,
It's
thank
an
you,
older
yeah.
version.
Mine's actually on the way, it just hasn't arrived yet, we're just waiting for that. Thank you, that's awesome. Oh,
I mean, it's the older version, but everything's pretty much the same.
okay, yeah, usually
Just
they
keep it
make
as a
them to
reference.
make some more money.
All right. Thanks a lot. Appreciate it. Great.
Thanks much, see you Tuesday.
All right, thank you. guys do again? What's your major?
I think we do though. I was looking at the
No
syllabus.
concentration.
And then it says, doesn't make sense to me. Like today it says assign homework number 1, and then like September 18th to the 20th says homework number 1. Dude.
Major
So I'm like, I don't know if that's homework number 1. Like,
Maybe that makes sense, yeah.
Well, get around, right?
yeah, same. I did ask him, and he was like, no, don't worry about it. I'm like, don't.
I can't.
Yeah, I was like, I don't get it. And he's like, no, it's gonna like, it's fine, it's fine.
The TA is the one right here.
Because all the stuff is like,
Yeah.
I
do not know what.
We're like split it.
There is. I tried doing it yesterday and I was like, it was due today and I tripped out for a second.
Usually the MBAs require just experience. The question is, why would you want to go right now? As opposed to, I mean, my recommendation is you really want to go right.
Yeah, well, so I'm kind of doing that.
Yeah, the goal is.
I know we use it.
Okay, so then probably not.
Oh, gross. I'm okay.
So it's not.
It's easier to get into
I almost died. It's fine.
the straight MBA.
I don't know why I'm here. Don't say what, but I'll kind of love it.
Because like, the spaces are blank, and it says like team 1. That's what I was saying. That's also true.
If you're not cheap, then you
Business, and I just dropped my concentration. So I global business? Because I picked up a minor that I thought would be more relevant to me. East Asian studies. That was a lot. Which is happening to my body. It's like 30 seconds.
I know.
I need to just like choke on my sweat.
It checks the box. It's not I think it would be, you know, probably program, cattle program. Those are all.
It's like, yeah, she tell me, she's like, it's easy, but when you the hang of it. Cause I was, when I got here, I was like, if she didn't tell me before, she got out of no, she's like not very good, but she's like, I would say like at a math level probably.
Is that 5 minutes per day?
I think it's just like she's going back and she's really good on
We have to do press release.
yeah.
I would work with the secondary.
Yeah, you get then you come to but then again, let's say you do it Tuesday, it's still like,
You should be.
don't do it Thursday, do your corrections, you make it. Yeah.
Before then, never had a problem.
And then you get
Hey, you know, you win some, you lose some, still got a good comparative on the project.
He can't get push it out. You want to grab
We were good.
we about to
So you guys are going today? I'll tell everybody the last one.
Thank you.
And I got all the PowerPoints. Are you guys team 2? Team 2? So you guys did. She did. Oh, okay, there's probably other we can do. So we can combine. But did you guys have to start that? You didn't do the presentation. Did you know you were going to do the presentation?
I like emailed you about the deadline because I was a bit confused on the syllabus.
Okay.
But we did look at the
Okay, but I need you to do the presentation. So the answer is yes. Right?
Oh, actually,
Now, are you new to the class?
Excuse me?
Were you here on Tuesday?
Yeah, I was.
Oh, okay. Anybody not here on Tuesday?
The memo. I thought, no, the group is the page.
So we're chapters 2 and 3.
They were completed.
Watch them already have it.
So that means you're gonna have to go on the.
Especially with the
Did you do chapter?
I'm gonna look at it.
Okay. Okay. And what team are you? Okay.
I've returned stuff.
Yeah, you
guys
can.
are gonna do chapter three. And then what we should do is they basically took the solutions.
Yeah, it's something I don't know how to do.
So is everybody in your group still have 3? You still have 3?
I'm not going.
You still have 3?
No, there's only 2.
Okay. And then you still have 3 in your group? Yes. Okay. And you?
Yeah.
You guys still have 3 in your group?
We have 4.
Can you move one of them over here to be with the team?
Yeah. Me?
Oh,
Where's the
sorry.
He's the group.
There's a guy from the section.
You want me to be like status?
there's one team that goes over. I gotta switch them around because I only have 2 now.
Also, I'm moving
So you got moved.
to that group over there, which is group number 2.
It's number 2.
Okay,
Yeah, and you guys gonna do chapter 3 next. You're gonna do chapter 3 next.
What's the name of the book?
I don't know. It's on there's a link.
So Willie
So I think we're still in town. Great. And then, just a little heads up. In the last class, it was really cool. The accounting students did chapter 3, right, the accounting stuff. And what they did was they embedded the homework problems in with the PowerPoint presentation. And I think that might be a good way to go. Yeah, so, and here's probably the way to do it, is I provided you with the solutions in Word. So you just bring that over, right, reformat it, and then learn it so you can present it, so you can walk us through it. So you're not like banging on the drum, trying to figure this stuff out. What you're doing is you're learning it so that you can present it. So you're gonna learn it anyway. It's just, I'm shortening the process to be more efficient. Okay, does everybody understand? Everybody listen? Everybody heard what I said? Okay, so I'm giving you basically more time to study the homework problems so that you can present them. Because I already provided you with the solutions. So you're gonna walk through the logic of the mathematics. Okay, right, is everybody clear? Okay, cool. So what I need you to do is, what we're gonna do is we're gonna do this every single class, okay? We're gonna simulate a trading platform, a trading room, trading room. You work for me, Derivative Trading Corporation. I'm the managing director. You're basically the traders in the organization. It's 5 o'clock in the morning. The bell's gonna go off at 6. Okay, it's 5 o'clock in the morning. London's closing. Tokyo, basically at the end of the day, Tokyo's gonna close. So when we come to work, London is closing. When we go off work, Tokyo is starting. It's 24 hours. Different teams start coming in at different times, and they overlap. It's 5 o'clock in the morning. You're gonna go back to your desk at 6 o'clock, because then the bell goes off. Usually within these meetings, they only last like 20, 30 minutes. But in our case, these meetings are gonna be less. Within the 20, 30 minutes, you give me an update of the markets. Ideally, you give me the updates of the markets, and you give me an update of the positions,
are the opportunities of the trades that you see in the marketplace based on the 5 major asset classes: stocks, oil, gold, bonds, and foreign currency. We trade in all of those. We do hedging strategies, we do portfolio management in all of those asset classes. You're the managing directors. You usually have 2 analysts working for you. As a managing director, you make about $500,000 a year with the potential for $1 million in bonus. You have 2 analysts that are working for you too, basically doing a lot of the research and testing all the trades based off of your recommendations. And then we come to the meeting at 5 o'clock in the morning every morning. We get an update on the markets. We figure out, well, is the stock market up or down? Do we think it's going to go up and down? Why? And then what would be our trades that we would place over the next day or the next week? We're not going to do all of that. But what we're going to do right now is every time you come into class, you need to turn on your computer, go straight to Yahoo Finance, look at the Yahoo Finance page, and see if there's been any political or policy events that may move the market.